Hey investors, welcome to my video on 20 common investment mistakes. Whether you are new to investing or a pro, we have got insights to help you avoid pitfalls. Let's dive in and make smarter financial moves together. Enjoy the ride. Learning from the great is crucial when learning how to invest, but it also pays to learn from the worst. To help investors be aware of potential hazards, a compilation of the top 20 most frequent mistakes has been made. If you recognize any of these errors, it's probably time to consult a financial advisor. Expecting too much or using someone else's expectations. Long-term investing involves creating a diversified portfolio with appropriate return and risk exposure. However, no one can predict real market returns, so caution and moderation are crucial when estimating expectations. Not having clear investment goals. The phrase, if you don't know where you are going, you'll probably end up somewhere else, applies to investing, as it's crucial to design a portfolio that aligns with long-term objectives rather than focusing on short-term returns. Failing to diversify enough. Adequate diversification is crucial for creating a portfolio with appropriate risk and return levels. Over-concentration in one security or sector can be disastrous, so finding a balance and seeking professional advice is recommended. Focusing on the wrong kind of performance. Long-term investors should focus on factors driving long-term performance, rather than speculating on short-term performance. Focusing on factors that drive long-term success is crucial, and refocusing on short-term chatter can be beneficial. Buying high and selling low. Many investors fail to follow the fundamental principle of buying low and selling high, often driven by fear or greed. They focus on short-term returns, investing in fads or past strategies, making it difficult to determine the value of an investment once popular. Trading too much and too often. Patience is crucial in investing, as it takes time to fully benefit from an asset allocation strategy. Modifying tactics can reduce returns and take risks. Use reconfiguration as an opportunity to learn about assets. Paying too much in fees and commissions. Investing in high-cost funds or paying excessive advisory fees can significantly impact long-term wealth. Be aware of potential costs, choose sensible fees, and ensure value for investment. Focusing too much on taxes. Tax implications are a common mistake in investment decisions, but it's crucial to prioritize a security's merits over potential tax consequences. Not reviewing investments regularly. Diversified portfolios may fluctuate, so regular checks are essential to ensure investments are suitable for your situation and don't require rebalancing. Regularly check in to ensure your portfolio remains relevant and sustainable. Taking too much, too little, or the wrong risk. Investing involves risk-taking for potential rewards, with too much risk potentially causing extreme performance variations and too little risk resulting in low returns, requiring understanding and awareness. Not knowing the true performance of your investments. Many people are unaware of their investments' performance, even knowing headline results or stocks' performance. To ensure success, it's crucial to relate the overall portfolio's performance to your plan, accounting for costs and inflation, and not neglecting this. Reacting to the media. News channels often profit from presenting tradable information, but it's crucial to separate valuable information from the noise. Successful investors gather information from independent sources and conduct proprietary research, as news is factored into market pricing. Chasing yield. High-yielding assets may seem seductive, but past returns don't predict future performance, and high yields carry high risks. Focus on the whole picture and avoid distractions. Trying to be a market timing genius. Market timing is challenging for untrained individuals, and staying invested can yield better returns. An investor who missed the top trading days would have achieved a 5.4% annualized return instead of 9.2% by staying invested. Not doing due diligence. Ensure money managers have the necessary training, experience, and ethical standing by checking databases, asking for references, and reviewing their work on recommended investments. Avoid mud-off schemes and avoid unnecessary effort for better sleep. Working with the wrong advisor. An investment advisor should partner with you to achieve your investment goals, sharing a similar philosophy and problem-solving abilities. The benefits of taking extra time to find the right advisor far outweigh the comfort of making a quick decision. Letting emotions get in the way. Investing can raise emotional concerns, such as involving spouses and deciding after-death assets. A good advisor can help create a successful plan based on these questions. Neglecting to start or continue. Lack of knowledge and inactivity often lead to failure in investment programs. Successful investment management requires continuous effort and analysis, not overly complex. Not controlling what you can. While the future is unpredictable, taking action to shape it can significantly impact wealth accumulation. Constantly investing capital over time can increase the likelihood of reaching financial goals. Forgetting about inflation. Most investors prioritize nominal returns over real returns, comparing performance after fees and inflation. Despite economic fluctuations, costs may still rise. Focus on real returns after adjusting for rising costs. If you find value in this video, don't forget to hit the like button, share it with your investing friends and subscribe for more insights. Your support keeps the content coming. Thanks for watching my video. Have a good day. Bye.